Welcome to a short summary on our third presentation of Mastering Your Personal Finances. Our first presentation was all about the nature of finance. The second presentation got rather personal and we looked at analysis, spending and saving patterns, so you could better understand your own situation and how to manage the finances within it. The third presentation was basically about using the way banks think and the way wealth managers think to get a clearer understanding of how to plan savings and spendings, and indeed deal with a situation, typical car going out of control, and these things happen a lot quicker than you expect. So we're going to start with a lovely quote from Hemingway when he was asked, "How did you go bankrupt?" And he said, "In two ways, gradually and suddenly." And that is the very nature of how people lose control of their finances. So to get to grips with the big picture before you lose control, what's very important here is power. In other words, when you have the time and the resources to do something. And equally, it's very important to know when you don't have the time or the resources to do anything. So quite simply, when a problem arises in a bank, the first three questions that are always asked are, firstly, what's the structure? Secondly, what's the structure? And thirdly, you guessed it, what's the structure? And structure is really at the heart of everything, way more important than a profit, a loss, a debt, and how you deal with it. So at its very core, societies organize themselves around structures. So if you look at the earliest forms of government, we go back to a French philosopher called Montesquieu, who was really the father of all political structures. He had this basic plan where if a country or a state is organized according to a legislature which makes laws, an executive which carries out the will of the lawmakers, and a judiciary which interprets or qualifies or measures or decides on the application of any particular law. Is it fair to everyone? Is it favoring one group above another, and so on? And his core thinking was, if you had three separate groups in charge of organizing a society, then it's highly unlikely that one would become too powerful, which was the case of the nobility in France before the revolution. So the way banks think is fairly straightforward, that you have the owners of the bank, generally the shareholders, and that can be a mixture of private individuals or private individuals and government shareholders, or even other banks partly owning banks. Absolutely nothing wrong with that, quite common. And beneath that first tier is the management. And the management of a bank is usually split into the board of directors, who carry out the will of, or carry out the mission statement of the owners of the bank. And they have to carry that out in accordance to what they were set up to do, what their mission is, and what their powers are. And the difficulty here is if a bank goes beyond its powers, in other words, if it makes loans to individuals or to commercial entities where they were never authorized to make those loans, then believe it or not, the status of such loans could be interpreted as a gift because they're acting beyond their powers. And for the very fortunate recipients, they may never have to pay that money back. So the second tier of organization within most financial lending banks is that you have one group of people in charge of the credit policy. In other words, working out ratios, how much we give out, which type of customers, the general risk management of, if you like, of the administration of finance. The second group of people, or the second committee, is usually the Credit Control Committee. And they are basically involved in supervising and chasing down bad loans and working out when loans have to be written off. So in other words, when money goes from the asset side of the balance sheet, that is, if it's a functioning loan and it's likely to bring in interest and profit. Now, if it goes from the asset side of the balance sheet to being written off, it goes to the liability side. And the credit committees are also in charge of working out future reserves. In other words, what needs to be saved against any danger of a loss. A key factor here is nobody is allowed to serve on both committees at the same time. So you can't have someone giving out a loan and then running over to the other committee saying, actually, it doesn't look too bad, it'll be paid back. No need to put a reserve there. So not only would that be bad practice, it's usually against the law. Now, moving on to wealth management for a moment. Wealth management is very, very simple, and it's about, again, a division of power. But with wealth managers, what they try to do with their wealthy clients, and when I talk about a wealthy client, I'm talking about a client owning at least or having at least 1 million cash surplus. That's after property. In other words, 1 million of liquid assets. And wealth managers only start there because the fees to manage a client, according to the following structure, would usually start at about $50,000. Now, you might say that's expensive, but if someone's paying $50,000 to $100,000 a year, well then after 1 year, they're already making quite substantial profits. So what every wealth manager will try to do is separate their client's savings and store it hidden away in one jurisdiction, have their wealth producing entity, be that a factory, be it a service, be it whatever, in a second jurisdiction, and of course their residency or domesticity, where their domicile, to be in a third jurisdiction. And can you imagine how difficult it would be for a tax official to make something stick in those circumstances? And the golden rule is that the wealth manager will insist that their client never stays more than 180 days in any one jurisdiction to avoid the notion of being permanently resident. That's an international law. Once you stay for 6 months and a day in any country, you have to declare your residency with the local authority. Now, there were exceptions made to that under COVID in certain jurisdictions, but in general, that's the nature of wealth management. Now, you might say, if you're not a high net worth individual, why should I be interested in this and how should I make use of it? Well, very simple. If you have a checking account, in other words, if you have a mortgage and you have savings and you have everything else with the one bank, then you're open to a little bit of pressure if something goes wrong. So let's say, for example, you run into financial difficulties, the bank will say, yeah, no problem, we can extend the loan, but we will have to take a hold or have a priority right over some of your savings or all of your savings. Now, on the other hand, if the bank did not have your savings within their enterprise, within their building, then you're in a stronger position to insist on a particular different arrangement. So very simply, if you're in the position at the moment to move your financial commitments to different houses, do so as soon as possible. In other words, never have all your eggs in the one basket. Now, to go back to our friends in the bank, where they have one committee looking after the administration of loans and a second separate group looking after the recovery of loans or the control of those loans, it's a very useful discipline to start with those structures in your personal finances. So the first one is, like a bank, What's your mission for the following 12 months? What do you hope to save? What would you like to, how would you like to see your personal balance sheet looking after 12 months? Is it you have increased savings? Is it that you have a lower mortgage rate? Is it that you've acquired specific personal assets? So that's your mission statement. How you do that was very much covered in our second talk, where we looked at best ways to spend, best ways to save, and opportunistic savings, opportunistic purchases, and developing a particular mindset where you know exactly where you're going, and then you never have to worry about looking over your shoulder. So to go back to the issue of the sudden car crash, and where we're under a lot of pressure, what's very unusual in the world is when things are going well for us, we get a lot of comfort knowing that we live in a wealthy country, that we have a good community that's quite stable. We've friends, we've family. Then we're in a job or an area of expertise that we know a lot about, that we enjoy, that we feel at home. And then that provides us with an income. The income trickles down to maybe further education, to our local shops, to support our family, our friends, our community. We pay taxes. So we very much have a basic pyramid structure, and everything working with a flat base, one structure supporting the next. However, this is quite interesting. If you ever find yourself, say, 48 to 24 hours from homelessness, and you're suddenly getting letters declaring that you've defaulted on loans, or you've become, if you like, as close to personal insolvency as could be. And what's very strange is that in such moments, we humans tend to go into complete shock and freeze. And in a way, this is sort of logical, because nature teaches us how to survive till tomorrow, how to hunt, how to be part of a group, how to socialize, how to pick up survival skills. There's nothing in nature that teaches us how to react in a financial crisis. So it shouldn't be too surprising that many people make very poor decisions under such pressure. So let's take a quick look at how banks think when faced with such situations. And you'd be surprised how frequent these situations do arise within the financial industry. So the first thing they basically look at is the structure. And how much of the situation can be salvaged, how much of it can be written off. That's just the day-to-day nature of finance. And banks are quite quick to write off situations if there's no possibility of salvage. And salvage sometimes means looking at the contractual arrangements. Does the defaulting party have savings in the bank? Is there a signature there for a guarantor? And beyond the banks, let's take a look at what large commercial entities do when they're faced in such a situation. They don't have the comfort of the bank knowing that the government will bail them out. So they run to the government, in this case to the courts, and they say, well, you know, we still could make things happen. And they say, you know, we could survive if we have a little bit of extra time. So what a commercial court will normally do is grant a protection order or a stay of creditors' claims for anything from 30 days to 90 days, and sometimes a bit more. And the idea here is the owners of the company hand over the day-to-day administration to a court-appointed official, usually called an administrator. So the administrator goes into the company, takes a look at the balance sheet and the order books and the cost structures, and makes a call, you know, no, this is beyond repair and beyond hope. Or perhaps with a little bit of pruning here, different management, a different agreement with the creditors, things can be put back in order. In other words, liquidation is prevented and life goes on. So the lesson to learn here is, if you are 24 to 48 hours from homelessness, try to look at things from the point of view of the people on the other side of the counter. In other words, people you owe money to, people you've done business with. And the best thing to do is just talk, and talk, but treat them all equally. In other words, don't pay one creditor above the other. Apart from being very unwise, you might discover it's possibly illegal in certain circumstances. So to wrap up, in summary, if you find yourself running out of control and your finances are dire, take a step back and ask yourself one very simple question. Are you actually the person you would appoint to deal with such a situation if there was a different individual, if there was a friend involved? If a friend came up to you and said, look, I'm going broke, can you help me? Well, you could say, no, I'm the last person you should talk to. Now, in that situation, be a bit like a company or a bank and take a step back and find one, two or more persons who would be the best to manage the situation. Don't stress yourself. Don't try to solve it all by yourself. And quite often, you'll find somebody who can turn the disaster into an opportunity. So above all, take your time, think, structure, be calm. And I hope to see you for the next presentation, where I'll be looking at risk management, and that's in terms of power of attorney, general insurance, and life assurance. So in other words, your day-to-day risks to your family, and day-to-day risks to your savings, property over the short and very long term. Talk soon. Many thanks.